Welcome to episode 3 of House Hacking with Halperin. Today I have a very, very special guest, fellow Compass agent, friend, confidant, investing expert, Chris Sweitzer. Chris, welcome to House Hacking with Halperin.
I'm flattered. This is my first House Hacking with Halperin podcast, and I couldn't be more thrilled.
It gets pretty wild.
I can imagine.
You come from a totally different background than myself when it comes to how we both arrived at Compass as brokers and how we both arrived sort of in this real estate investing world that we're in. I feel like I came from left field and you came from right field. So take us back to right field a little bit and give us a little bit about your background and why your perspective on some of the things we're going to talk about today.
In a sense. So I started my career out of college working for a pretty sizable real estate private equity firm called Cedar Street Capital. They are mostly focused on multifamily, larger scale investments where they're buying existing buildings, doing full gut rehab, adaptive reuse, and turning them into apartments that you see today. Fast forward a few years, I moved on to a much larger company called Sterling Bay. They developed the McDonald's HQ in Chicago, formerly Oprah's studios. And there I was focused on underwriting pretty large scale acquisitions of large office spaces, developments such as the Google headquarters, the McDonald's headquarters. So that was a very analytical job where it was kind of thrown into the trenches, given all the available due diligence material, figure out, hey, what is the potential of this building? What are the existing leases? Are they under market? What can we accomplish based on renovations and achievable rents?
Give me a dollar amount on one of the projects that you helped underwrite.
So the biggest project was the acquisition of the Groupon building at 600 West Chicago. And that was a $500 million acquisition. I was the lead analyst on that, essentially extrapolating the entire rent roll, which is all the existing tenants. Groupon at the time was occupying, I want to say, about 1.2 million square feet. Figuring out what the existing cash flow is, what kind of renovations had to be done to the building to get it up to what's called Class A office space, where you're going to attract some of these grade A office tenants such as Groupon, Tempest. That involved a very, very intensive analytical underwriting, modeling, projections, and determining exactly how to maximize the value of that building. In doing so, that involves coming up with a model where you're able to pitch it to investors, and in this case, large institutional investors, being able to put up $100 million, $200 million to capitalize this kind of deal. So you're going out to the Wall Street giants of the world, such as JP Morgan Asset Management, figuring out the capital structure, how much debt you're going to be able to take on, how much equity you're going to be able to take on. And all of that is a byproduct of essentially what the building is going to perform.
It's a lot.
It's a lot. And it involved a lot of months and years of my life, but it was an extremely invaluable position that I held there. Is extremely helpful to bring to my clients today and what you and I are doing.
Let's fast forward 4 or 5 years. You had this insane experience that you just walked us through, and everyone appreciates you for that. You were basically tasked with underwriting a $500 million development. Everyone knows the building he's speaking of. It's a fixture in that neighborhood in Chicago. Now you're underwriting and developing a 4-unit renovation project. And I'm going to make up numbers. Let's call it a $200,000 project.
Okay.
So we are talking about fractions of what you've done in the past. What I want to know, similarities between the two, differences between the two.
So, I mean, being extremely different price points and different types of properties, you would think that it's going to be a completely different process. But in the end, you're really focused on a few primary components for both properties. You're focused on A, what is your purchase price? B, what is your renovation cost? And if you add those two together, you get your cost basis. And then you got to figure out, hey, if I'm going to sell this in 3, 4, 5 years, apply a cap rate to it, and is that going to be enough of a purchase price where I'm going to see enough of a return that's attractive to investors. Yeah.
So analytically speaking, more similar than I would think. We're looking at acquisition, improvement, and after repair value, basically.
Yeah, as well as your cash on cash return, which is essentially the amount of money that you come up with day one and you put into the deal. Yeah.
So far, all you've talked about is analytics, analytics, analytics.
Yeah. Those analytics draw from comparable property sales. So you see what is sold in the neighborhood to figure out, hey, if I'm going to sell it in 2, 3, 4, 5 years, these are comparable sales, and assuming market conditions persist, here's what we could potentially expect sell it for. Also, you're going to want to project what these market rents are going to look like, and you do the same exercise. You see what's rented in the area to figure out, hey, we're going to put in all this work, we're going to renovate these units, and we're going to get them up to market rate. But the biggest difference between the $500 million deal and this 4-unit is when you're working for a big corporation, as I was, you have a full team of contractors who are giving you the budget. They're telling you this is what X, Y, and Z is going to cost. And so I'm just taking that information, throwing it into the model, and running with that.
Got it.
Whereas with a personal investment or the smaller 4-unit, for example, I have to hire my own contractors, consult people like yourself who are experts in the construction field, and really figure out how much is a new countertop going to cost per unit? How much is it going to cost to redo all the plumbing? How much is the electrical going to cost? And so being able to really understand those costs it can be tricky for newer investors, and you really need to get first, second, third opinions and be conservative with those costs, because
for sure,
there's always going to be something that pops up that's going to cost a little bit more than you expect. And it's always better to have a little cushion in that budget, and you don't want to run out of cash, especially with a 4-unit that's completely under construction. You don't have any tenants in there. You're not getting any income while it's under construction. So you need to have a reserve amount in that bank account.
For sure.
To pay your debt service each month, pay for any out-of-pocket expenses, as well as real estate taxes that are going to come up this March, April. Hopefully by then we'll have the property fully occupied or stabilized and bringing in.
Was this something you knew going into the project, or are you telling me lessons you've learned throughout this project? Don't forget the boring shit. It's not necessarily how much your down payment is to your acquisition price and then construction price.
So you need to take a look at the past gas bills, the past electric bills, the past tax bills. It's going to be empty for 3 months, and tally up all those numbers and give yourself a cushion so that you have that money in the bank, and when you have to pay your monthly ComEd bill, you can do so. And it's always good to have that cushion so that when you start bringing in that income, you start inflating that bank account balance, and then you're able to distribute cash depending on what you expect coming up and fulfill that duty as a fiduciary to, let's say you have investors in the deal, to pay them back and start distributing cash.
I am going to get you to step out of corporate Chris shoes by the end of this podcast. I'm taking
Please
you back.
do.
I want the feels. When you're underwriting $500 million deal, talk to me about some of the intangibles with the 4-unit. Outside of your damn spreadsheets, Chris, what are some of the things you had to think through, that you've had to go through? Was your purchase purely a spreadsheet decision, or was there other factors that went into it as well?
Like you said, there are a lot of intangibles, especially with a personal investment, and you're going to be hiring a contractor, let's say. The intangible number one is you're going to have to be going on site every day to meet with the contractor and make sure that they're doing what they say they're going to do. Which is something that's super important, because if they're working on a unit and they finish it off and you're not there to walk through it with them and point out, hey, you messed up on the paint job, you have to fix this. So intangibles such as that, and having a really good relationship with the contractor is important, and being able to communicate very, very well so everyone's on the same page.
Sure. So
that you're not encountering what's called a change order, where the contractor says, oh, we gave you this scope of work, and you want to add an extra door to one of the bedrooms that wasn't in our scope, and we're
Yep.
going to charge you an extra $400 or $500 to do that.
Yep.
I would say the biggest advice would be, before you close on the project, really finding a good contractor.
You're now the third person in a row who has given that as the number one piece of advice.
Yeah.
And it's not easy.
Going through the building and really digging in to the scope of work. Might say, we're going to remodel every bathroom, every kitchen, new appliances. And you might say, all right, that's great. They're going to renovate all 4 units.
Yep.
But what you're not thinking of is, let's say there's a door missing on one of the bedrooms. Before you sign that scope of work or that bid or estimate, you need to go through it from top to bottom. You need to set expectations right up front. Because if you don't, these contractors just stick with that initial bid that's been approved. You need to cover all your bases up front.
For sure. When you go from like a Sterling Bay analyst to Chris Sweitzer LLC real estate holdings, how do you change the way you're looking at exit strategies when you're evaluating this property? Are you planning to sell it? Are you planning to rent it? Have you thought through keeping it for the rest of your life?
No investor or house hacker can predict what's going to happen in the market a year to 5 years down the road. For me, I like to look at it from a 5-year horizon. And so I typically would like to underwrite a 5-year hold, just so that people have an idea as to what the cash flow looks like that far out. And the idea is, once you get it rented out and fully stabilized and you've completed all the renovations, and let's say the market conditions are really, really good and there's a lot of buyers out there, let's call it 8 months from purchase,
Yep.
then you start potentially shopping it around, either quietly or on market. And if you get an offer that you can't refuse, it makes sense to sell. Alternatively, if the market is down and you've leased it up and it's spitting off good cash flow, then you hold on to it and wait until the market turns and you find an opportunity to sell.
You're giving yourself a 5-year horizon to pivot as needed and find an eventual landing place. Whereas a flip, like many people that I run into want to do, you have 1 year to maximize that piece of real estate. If that 1 year horizon happened to have fallen or happened to cross paths with historic interest rate jumps, you don't have a pivot. What happens if you can't offload it? You're coming up on year 2, year 3. Now what are you thinking?
That's when underwriting, understanding the numbers becomes so important, because you want to be very conservative and feel that maybe I'm not able to sell it year 1 through 5, but are the rents strong enough to support it and spit off enough cash flow where maybe we hold it for 10 years and you're clipping a coupon, you're getting that dividend payout as opposed to putting that money in an ETF or in the stock market.
Sure.
And you're also getting some tax advantages with depreciation, being able to write off capital expenditures and whatnot. The idea is to give yourself enough runway where, depending on market conditions, you either look to sell it or you hold on to it. And once the term of the loan comes due, you either refinance it with your current lender, or if market conditions are good, you look to sell it.
These are all exercises, if I know you, that you're going through before you even purchase the property.
Before you even go under contract.
This is what a refi would look like at this interest rate. This is what a possible sale event would look like. This is what it would look like if I have to hold this building for 5 years and rates stay high.
Yeah.
Right? And you're checking boxes on each of these scenarios and making sure that you can live your life.
Yeah, and this is where it kind of gets into the weeds. When modeling, I like to do like a sensitivity matrix where it shows what are the returns going to look like if I sell it after 12 months? What are they going to look like after 24 months? And those numbers have to be attractive enough to pursue the deal, essentially.
Is that almost like kind of stress testing it in a way?
Exactly. You figure out after 12 months, here are the gross rents, here's what your expenses are, here's what your net operating income is. And based on recently traded properties, we can tell, hey, in West Town or West Loop, 2 to 4 units are trading at, on average, a 6.5 cap.
Yep.
And so you apply that 6.5 cap to that year or the forward year NOI, and you figure out a sale price, and it's essentially a stress test.
If they don't have you and these models and we want to keep them off bigger pockets, what can people do if they are just scrolling through compass.com or Zillow, looking at properties, trying to analyze it? If they could only choose a 20, 30-minute exercise as opposed to your sophisticated models, give some advice as to like how you would underwrite from home.
There is a resource that I actually like to use for quick analysis of a property. I believe the URL is rentalpropertycalculator.net. If you're looking at a listing, you can typically gather pretty quickly. You can get a pretty good idea as to what your insurance is going to be. You can put in a number for miscellaneous repairs and maintenance, and then your utility costs. It's super helpful. It's super quick. And for people that are trying to get into this, it's a really good exercise to just pull up a few listings and just start running through it and getting familiar with it.
Yeah.
You go in there, put in all your assumptions, click calculate, and it shows you exactly all the metrics that most people, investors, want to see. How much money am I going to net a month? If I'm house hacking, one of the units is going to be vacant. You don't apply any rent to that.
Right.
And it'll show probably a negative cash flow number. And that's what you would assume as your...
That's your rent.
That's your rent.
Yeah.
That's your net out of pocket per month.
So if any of you guys and girls go ahead and play around with that website and you need help with some of those fields, feel free to shoot Chris or I a message at any time. We're always happy to help for free. And then I think the cool part about that too is then we could start analyzing. We could also start to help you kind of understand where those numbers can be manipulated to help spit out better deals, right? Yeah. A lot of times if you just take the existing deal, it's not going to look very good.
Yeah, because if the building needs some work and maybe there's current renters in the building and they're paying way under market, they've been there for 10 years and the owner hasn't increased their rent, and you got to figure out based on what's recently rented in the area, what after renovation rental value that's going to look like to run what's called a pro forma or after renovation numbers to understand exactly what it's going to look like from a cash flow. And
for sure. When I buy a building, I physically go there, I breathe in the air, I look at some of the history of the architecture, I look at the neighborhood, I go get a coffee at the corner, think about owning this building maybe for the rest of my life. Is it always corporate, Chris? Is there anything else that plays into your decision-making process, or is it just about numbers?
It's not just about numbers. I toured the neighborhood even before I saw or stepped foot in the property, and it's right down the street actually from where I live. And if a tenant calls you late at night and they say, oh, the heat went out or the electric's not working, you can quickly get in your car and go by and fix whatever needs to be fixed. And so proximity is really important. And also, I have a very good feeling and I really like this neighborhood in Westtown. And there's a lot of cultural activities that are going on, especially on Chicago Avenue.
Sure.
One of the best restaurants in the city of Chicago. It's gotten 3 Michelin stars. Kasama, one of the best Filipino restaurants in probably the Midwest. A lot of great coffee shops.
And these are things that don't plug in on a spreadsheet, but guarantee it played into your decision-making process. And I think that's where we probably need to meet in the middle, right? The farmer's market's down the street. This is a Greystone. I live just down the block. Wait a minute, it's negative cash flow.
Yeah, there are those intangibles that are really important. You have to be able to see the growth of the city and how it's being transformed and where people are looking to move, whereas traditionally younger professionals were dead set on being in River North. Nowadays, we're seeing, being in our field, a lot of younger professionals are looking further west and they want to be in this kind of West Town, Noble Square or West Loop, Wicker Park. So it's been kind of an explosion of growth in those neighborhoods, which I think is great and super important when looking at these types of deals. You need to understand the population, what's going on culturally and shopping, nearby grocery stores.
When someone says, hey, what are you going to do if this one doesn't sell or this one doesn't rent? My answer is, I'm moving in. Again, it's a half joke, half truth. A lot of you folks out there in your first investment, think it through. If for some reason it doesn't perform the way you want and you're sitting at home paying $3,000 a month in rent, to remedy that issue simply means you moving into your investment. There's no shame in that. If you have any more questions for Chris or myself, or again, if any of you guys are playing around just trying to underwrite possible deals, I know a bunch of my own clients are out there right now trying to figure out what's a good deal, what's not a good deal. Chris gave you a great resource for that. Call, direct message, either of us or anyone at the Ben Lala's team. Drop by 2200 North Damon. You can literally walk in the door, and we want nothing more than to help you guys get your investment career started. So see you in episode 4.